Hi there, my name's Tim, and over the past 15 years or so, I've helped hundreds of people acquire property in my role as a property investment advisor and as a property investment educator. Now, most of my clients were first-time investors, and so naturally there was a fear of taking that first step, a lot of nervousness around, what was required to become an investor. And I found even in my own journey starting out, what really helped was having a process or having an understanding where I was starting from and what I wanted to ultimately end up achieving. So in this video, I'm going to share what I believe are my 5 most important steps to acquiring your first investment property. When I was taught how to take investing seriously, it was explained to me pretty early on that property investment was very, very similar to running a business. So it's all about having a commercial approach to what we're doing, and to understand where we are at and who we are or what our investment rules are, we really need to consider some factors, and I've listed some there below. So number 1 on the list there is funds to complete. So this is the amount of capital we have, either in cash or equity in a property, to cover such things as a deposit, the closing costs or purchase costs, which would include stamp duty, etc., legal costs, and also ideally to have as personal and investment buffers. So with our borrowing capacity, this is basically what the lender believes we can service comfortably in a level of debt. So together with the funds to complete, this will give us a pretty good indication of how much we can actually go and spend on an investment property. So when we're considering risk profile, we normally categorise into 3 areas: conservative, balanced and assertive. So it's important that we get an understanding, particularly if we're acquiring property with a partner, just to make sure we get a good balance across different profiles. And what it'll help us do is also determine things like the rate at which we're going to acquire property, the type of property that we purchase. For example, I've had clients that have had very, very strong borrowing capacities, had a lot of funds to acquire property with. However, they've got a conservative profile, risk profile, and therefore running out and buying multiple properties very quickly just didn't match their comfort level, their risk profile as such. So it's important that we get an understanding of what that looks like to determine our rules, or part of our rules as investors. So the purchase price basically follows on from funds to complete, borrowing capacity and risk profile, and it could be such that our purchase price is fixed because the funds that we have to complete and the borrowing capacity is such that we can't go over a certain purchase price. So therefore, it's no point going out shopping for a property at $600,000 if our borrowing capacity and the funds that we have complete only allows us to acquire property at, say, $400,000, just as an example. So knowing what those first 3 things look like, funds to complete, borrowing capacity, and our risk profile to a certain degree, that will also then determine our purchase price. And it could also be that if we've got a certain amount of funds to complete and a certain level of borrowing capacity, then we can then determine, well, if our risk profile suits us to take action in acquiring a number of properties, then we can also reduce that purchase price down to make sure that the funds that we have and also our borrowing capacity doesn't stop us, or buying a property at a certain price doesn't then stop us from buying a second property because we've used up too much of the borrowing capacity and too much of the funds. So the cash flow position relates to our family unit, so be it husband and wife with kids, single people, whatever that looks like. Basically, if we are going to get this right, then we really need to have an understanding of how profitable our family business is. And therefore, what we can do then is match the cash flow of a particular property back to our affordability level. Now, the number 1 reason investors fail or they have to sell property is because they don't take this into consideration. They end up acquiring a property that they just can't afford. It just doesn't match with their cash flow. We don't want to sit at home and eat baked beans. We don't want to move into a tent just so that we can hold on and sustain a property portfolio. So matching the cash flow position of a property with the cash flow position of our family unit is critical in making sure that we can sustain a property portfolio, or even just the property itself, let alone build a portfolio. So it's very important that we get this right. Alrighty, so level of involvement covers off a couple of things here. Firstly, there's two main types of investors. One is a passive investor and the other an active investor. So a passive investor is somebody who's hands off. They really don't have the time, or maybe they don't have the interest in doing all the work, doing the research, making offers, following through the process that is required to acquire a property. And an active investor wants to do all those things. They've got the time and they've got the interest level to run through that process and do the work themselves. The other thing we need to consider is type of property investment strategy that we adopt. So if we're time poor, if we don't have the experience in certain areas, so for example, everybody sort of falls in love with the idea of running out and grabbing a rundown property and doing some work to it and making $1 million from reselling it. We have to be realistic around what that looks like. So if we're looking to do a development or a renovation type strategy and we don't have a lot of free time and we don't have the experience, then we really need to adjust our thinking there and make sure that we're not getting over our heads in what we're able to control. Okay, so that was step one. Step two, we're going to take a look at the cash flow position of a property. So as we mentioned in step one, it's not only important to have an understanding of the cash flow of property, but also to the cash flow position of our family unit. That way we can match the property cash flow position with our affordability level. So it also will save us a lot of time. Again, when we go shopping for a property, if we can look for a property or properties that have a certain rental income ratio to purchase price, then we'll target down or focus down on the type of property that fits our investment rules. So let's have a look at step two, which is all about the property itself. Okay, so if I'm looking to calculate the cash flow position of a particular property, there's some factors that I need to consider to perform that calculation. Now, for my purpose, when I'm looking to qualify a property, I'll often use a calculator as a guide because there are some of the factors that I won't have exact numbers for. However, the calculator will give me a very, very good understanding of what that position will look like. So then if I find that a cash flow position of a particular property is, for example, negative $30, therefore I need to, after all things are said and done, I need to find $30 a week somewhere to support that property. Now, in step one, when I calculated my family cash flow position, if, for example, again, that it was $100 a week that I was happy to use to support an investment property, then that $30 is a third of that buffer. So I know I'm pretty close, and that property is going to be pretty close to, again, being what I can afford and what will allow me to sustain that property over a long period of time. Now, let's say, for example, instead of being negative $30 a week, the cash flow position of the property I was considering was positive $30 a week. So said another way, it had a positive income of $30, so positive cash flow position of $30 a week, then it's actually providing me with an income from day one rather than me having to use my savings, my surplus, to then support that property. So let's look at the factors that are involved in performing a cash flow position for a particular investment property. The first one is personal income. So this will be the dollar amount that we earn basically as an employee or as a self-employed person. Next one down is rental income. So this is the income we earn from tenants renting our property. Now, if the property is rented already, then we'll understand obviously what that amount is. If it's not, then we most likely have to speak with a property manager to determine that figure, or we can do some online research as well to get an idea of what that figure may be. Depreciation is another factor to use in the calculation. Now, you can use companies that have calculators on their websites, but you're really going to need to contact a quantity surveyor or use their website and their free calculators to determine what that figure might be to use in that calculation. Holding costs, ongoing costs, costs that are associated with holding the property. So, for example, it might be property management fees, taxes, rates, maintenance costs, etc. And typically they could be as an average around 30% of the rental income that you receive. Okay, now the loan amount. So this figure will be the amount of debt you take on, or the loan amount that you take on to acquire this property. So if you're using equity in an existing property to fund the deposit and the purchase costs, then you need to take in consideration those as well. So ultimately, if you're borrowing the whole amount, 100% of the purchase price plus purchase costs, then it'll typically be around about 105% of the purchase price. So everything regarding that purchase has been funded in the way of a loan. You haven't used any cash at all. If you do use cash to help fund the purchase, then you don't use this amount. It's purely the cost or the total loan amount that you've had to take on to acquire this property. The interest rate, well, this one's pretty straightforward. So this will be the interest rate on the loan that you've taken on to acquire this investment property. So once those figures have been punched into a calculator, the end result will either be a positive cash flow position or a negative cash flow position. And whatever it is, you then need to work that back, as we mentioned before, to your family unit's profitability or affordability position. Well, there's a number of different resources we have available to us as property investors. Some are free and others we're going to have to pay for. So it depends on the level of research and detail you want to go into. But what we'll do now is we'll have a look at some of those options available to us. So the first site we're going to look at is realestate.com.au. Now within this site we've got the ability to view properties that are for sale, properties for rent, and also sold properties, previously sold properties to do comparisons. We can enter a suburb, postcode and search by market that way, and also to drill down on a particular type of property we're looking for, number of bedrooms, bathrooms, etc. And within the site too, we've got the option of downloading or viewing a suburb research profile. Domain.com.au, very similar to realestate.com.au. Within this site, we can also search for properties for sale, for rent, and previously sold, and search by particular suburb or postcode as well. So very similar to realestate.com.au. When it comes to market research, Terry Ryder's Hotspotting is a great site to at least have a look at. You will have to pay for the reports, but there are a large range of different types of reports, from state reports down to actually cities and large regional towns. So there's quite a variety of options there for us as property investors. CoreLogic is another good source of market reports. If you scroll down through the page, you can see also too that they do have economic reports also, but again, a large range of reports. You will also have to pay for the majority of these type of report from CoreLogic. And the last one we'll look at is Residex, and you can see in the middle of the page there that they do offer free suburb reports, which can be very helpful. Okay, so I just want to add in here that if we fall in the trap of thinking that we have to invest in the area in which we live, or we think that all areas are in the same phase of a property cycle at any given time, then we can miss out on a few tricks. So don't be afraid to look outside the area that you live in, interstate. You've got all these resources available to us, and what we've looked at earlier, just scraping the surface, and we've got our team around us as well. If you do need to travel to look at a market, then that's okay, but falling into that trap of thinking that our market is going to be the same as any other market out there is not right. We can hold us back, particularly if you've got a strategy that is a short-term strategy where you need growth straight away. Then if your market's not within that growth phase, then and you think that all other markets are going to be the same, then again you could miss out on a few tricks there, and it can hold you back. And time, we don't get the time back. We need to make sure that we're investing when we can and when it's right for us. The potential members within your wealth team can vary depending on whether you're a passive investor or an active investor. The more passive you are, the likely that you'll require more members of your team. And some of these members you'll use more often than others. So for example, you'll spend a fair bit of time with your mortgage broker compared to, say, a building and pest inspector. Your accountant, for example, you'll probably spend more time working with an accountant than you would with, say, your solicitor or conveyancer. So at some point, though, you'll need all these members to be active within the process of acquiring a property, and not only through that acquisition process, but also beyond there as well. Obviously, a property manager will be beyond or as you own that property rather than just leading up to owning the property. And also to someone like your mortgage broker, if you're looking to acquire multiple properties, then building the right type of loan structure, getting advice and having updates on where you're at as far as borrowing capacity, equity, etc., will be something that will play more of a part in that process of building a portfolio. Making an offer. So what's involved in making an offer? Well, first of all, and we've discussed it a few times throughout this video, is that we need to approach this with a commercial mindset, if you like. So it's not about falling in love with the property. It's not about the colour of the letterbox or whether it's got a nice garden or not. It's really about the numbers, and it really is about our rules. So if we are willing to stick by our rules, then we're not going to get hurt. So firstly, we know our maximum purchase price. Again, we've discussed this several times throughout the video. So we know, therefore, that if the agent or the vendor is trying to push us above what we can afford, then we say no. And that goes on to the second point, is that be prepared to walk away. There's always another property out there. I think the saying is that the deal of a lifetime comes around once a month. So be prepared to walk away. It's not worth overspending or overpaying for a property just because we felt like we wanted to win the process. Also, what I think is handy is to state your purpose. So if you're dealing with an agent, I think it's worth straight up is to state that you are an investor, then you're looking to rent the property, because you don't need to hear a big spiel about how beautiful the property is and when can you move in, blah blah blah. So state your position, state your purpose. It's for investment purposes, and you're all about the numbers. You want to be polite, if you like, in this process. There's no point putting anybody offside. You may need to work with these people later on, but again, there's a difference between rude and being firm in what you're stating to the agent. And if you can, try and find out the seller's motivation. Now, it's difficult to do because the agent is working for the seller, so they might be guarded in what they're willing to disclose. But if you can find out that it's, people are moving interstate, they need to sell quickly because they've got to relocate because they've got another job to start, then that may work in your favour. But the main thing is to make sure that at all times you keep that commercial approach, and at the end of the day, you're willing to walk away if the numbers don't stack up and you can't get that property for the purchase price that you're after. Now, common sense plays a part. If you've said that your maximum purchase price is $400,000 and the vendor won't budge on $402,000, then really that $2,000 isn't going to make a real difference in that cash flow position of that property, and therefore your affordability. And if you've done all the work and you know it's a good property, it's in a good market, then it may be a bit silly to dig your heels in that much and say, well, no, I'm going to pass on this property just for the sake of paying another $2,000, as an example. So making the offer, there are some things that we can control, others that we can't. Again, walk away if it doesn't stack up, because there is always another deal out there. Make sure that if you've done your homework, you know what your rules are, you know what the market wants, then you stick to that, and everything should work out fine, because you've done, again, far more than the average Australian investor does before acquiring a property. So effectively you've ticked a lot of boxes, you've done your homework, you've done the right thing, you've done your research, then everything should fall into place from there, and you've got your team around you to help you. So basically the hard work's been done. You just need to now lock the property away, find some tenants if they're not already in there, and work with your property manager in maintaining that as a nice part of your portfolio if you decide to buy more than one property. Well, I hope you found this video helpful. If you did and you haven't already, please feel free to subscribe to my channel. That way you'll be notified when I upload additional videos. Also too, if you're happy to like the video, that way I'll have an understanding of what or the type of content people are after. Thanks again, and all the best with your journey.